Well, State Bank of India has reported its third quarter numbers, missing street estimates with a profit decline of around 35%, but that is on account of an exceptional item. There's lots more to talk about, so we have the man of the moment, Mr. Dinesh Khara, Chairman of State Bank of India. Thank you very much for speaking to CNBC-TV18, sir.
Thank you, Ritu.
You know, on the third quarter numbers, of course, the first thing we'd like to ask you is this profit decline that we've seen. It's on account of the extra provisions that you had to make when it comes to the DA relief and the pensions. Going ahead, is there any leftover impact that will have to be factored in, or is it fully provided for now?
Now it is fully provided for as far as the pension and the DA relief are concerned. We are fully provided for, and it is also an outcome of a long outstanding case which was there before the court of law. And now there was a very clear visibility in terms of the likely liability. There was a set of employees in the bank who were drawing pension at the rate of 40%, and the other set of employees were drawing pension at 50%. Now, on account of ensuring that all should draw pension at the rate of 50%, a decision was taken, and there is a very clear visibility that it will be paid in future at some date. But nevertheless, since we have a very clear visibility, we have already provided for this, and all this money will be, which is provided for, will be credited to the fund, which will take care of the pension liabilities going forward. This was having two components. One was 5,400 crore, which was on account of pension difference. The other one was about 1,700 crore, which is on account of the dearness relief, which was payable to the retirees prior to 2002. So that is something which has been taken care of. No more provisions are required to be made on account of this one-time item which we have provided for. As far as the other item which I would like to talk about is, it is the increase in salary and wages.
Those negotiations are continuing.
Oh yeah, we started providing for it at the rate of 10% in November 22. Subsequently, we stepped it up to 14%. Now, there was an MOU which was entered into between association federations and the bank management, and based upon that MOU, this liability is likely to be about 17%.
Okay.
So based upon that, what we have done is we have provided additional about 6,100 crore in this quarter, which takes care of the liability at the rate of 17% from November 22 to December 23.
Got that.
And now we are required to make only one more provision of 5,400 crore for the last quarter. With that, our liability for, in fact, that will be only if at all it is not paid before during this period between January and March.
Okay.
Suppose if at all it would have been paid, then there is no additional provisions.
So there will be another one-time impact in the next quarter.
About 5,400 crore. So if you really look at it, 7,100 plus 6,000, about 13,000 crore.
Okay.
In the next quarter, we will be required to provide only 5,400 crore.
Okay.
So we will be better off in terms of about 8,000 crore plus.
Well, let's talk about the fuel for growth for State Bank of India, and that is deposits. But across the system, we've seen a bit of a slowdown because investors are chasing higher yielding assets. Even for you, the growth in deposits has been lower than some of your peers at just 1.5% over the previous quarter, especially domestic CASA. That's actually gone down sequentially by 25 basis points. Give us a sense of how you're seeing this scenario play out, whether you will have to hike deposit rates much further to be able to get back some of those customers.
We are having a credit deposit ratio of 66%. I think we are having perhaps the lowest, which very clearly means, and also our liquidity coverage ratio is at 130%. So we are, as far as the liquidity is concerned, it's not a challenge for us. And we have grown as far as the loan book is concerned at about 14% plus, and our deposit growth is at about 13% plus. If you really look at it, our deposit base is around 46 trillion and loan book is at about 35 trillion. So we are actually taking care of whatever increase in lending which is required to happen in this economy. And for us, I think we are very mindful in terms of underwriting the quality assets, and that you would have seen in terms of our credit costs also. And considering that, whatever suits our risk appetite, we are happy to support such kind of a loan growth. Now, in terms of the CASA, which you have just referred to, we have seen in the industry there is a trend during the inflationary conditions. Normally, people move their deposit to higher yielding assets, including interest rates also. So we have seen such kind of a traction in the past also. If you really look at it, in the pre-COVID scenario, the CASA used to be at 40%.
Yeah.
During COVID only, it went up to about 44%. So now again, we are coming back to the pre-COVID scenario. So that is one of the reasons why probably it's coming down. But yes, of course, when it is coming down, it is something which has been looked at and critically analyzed also. But I would like to say that the drop in CASA for us is much lower as compared to some of our peers.
But, do you think there's further deposit increase that you still have to do? That may
No,
cause...
I think we are comfortably placed as far as deposit is concerned. And we have grown at about 13% plus, which is better than what the growth we have seen in the last quarter. And our loan book growth is at about 14%. So I think we are quite comfortable players. I don't expect
no more
that will
deposit
be
rate
required to
increases.
increase the deposit interest.
But margins have sequentially been coming down under pressure, and even this quarter this come in at about 3.22%. Do you expect this pressure to ease off anytime soon? At what level will you be able to maintain the margins?
See, roughly what happens is that our increase in interest rate has happened mostly in the term deposit. And that term deposit also, we generally see a significant portion of the term deposit coming in the 1 to 2 year bracket. And that is one of the reasons why I would say that since we have increased these interest rates somewhere in November, December, I would say that majority of the term deposits would have already got repriced. So only small bit of it would have been left out, which would be due for repricing. So that's the reason why I'm expecting that maybe it might have an impact of another maybe 2 to 3 basis points, not more than that.
All right. You obviously need for this kind of credit growth rate to sustain, which currently is at about 14-15% for you, the deposits to also catch up. And in the scenario that there's this wider gap between the two, do you think you'll stick with your guidance of 15 to 16% growth for the year, and do you expect it to go up from here, maybe in the next year?
I would say that if at all we look at the gap in the industry, because there the credit growth is at about 20%, deposit growth is at about 13%. So as compared to that, we are much better placed. So I don't expect that we'll have a scenario, and rather have a much more comfortable position going forward. And that is something which we would like to work on and see to it that it works to our advantage.
But what could you tell us in terms of your expectations about your advances growth? Where are the sectors you're seeing demand? What is the level that you're targeting? Could you exceed your earlier guidance?
We have, I think in the past also, the guidance which I had given was somewhere in the range of about 14 to 16%. So we are on track as far as our loan growth is growing at 14% plus. I think more than the number, we are very much cognizant of the quality which we would like to underwrite. As you have seen that our credit cost is 0.25%, and we would like to maintain this going forward. And with that in mind, we'll be little selective in terms of the credit risk which you undertake. But I would say that even now also, when it comes to the corporate credit, we have got a pipeline which is almost as strong as about 4.6 trillion. So we have
largely in the private sector.
Yeah, it was almost about 75% would be in private sector and 25% would be in the public sector. So we are observing decent opportunities, but there's always some kind of a lag after the sanction and the disbursements. But nevertheless, we are seeing good traction as far as corporate book is concerned. SME, agri and retail, they are the one which are growing at a decent pace. We expect to, in fact, we have invested well in terms of our loan management system and to improve the delivery when it comes to SME and also in the retail, we have invested very well. So that is something which helps us in ensuring that our processing times are reduced and we're in a position to serve our customers much better.
So speaking about your loan book, we've asked you this before about your unsecured portfolio. We appreciate that 97% is to salaried accounts, and therefore you made that statement that maybe your unsecured book is stronger than your secured book. But give us a sense of whether, in light of what the regulator has been warning about, what you're seeing in the market, will the pace of growth continue at the current rate for the unsecured book?
I expect it to continue, and particularly when it comes to the regulator's concern. To my mind, those concerns were essentially emanating from the fact that there were large number of low value unsecured loans which are being extended by many of the players. And that kind of underwriting was not subject to any kind of a detailed scrutiny in terms of EMI, NMI, in terms of the loan to value, etc. So that is the reason why regulator came down heavily. But when it comes to our loan book, which is there in the unsecured space, we don't have any such concerns.
So asset quality, let me get to that, and we're only getting to it now, which speaks volumes about how much improvement we've seen in the system overall. But you know, this 40, 90, 60 crores of fresh slippages you've had in the quarter, were there any bulky accounts, you know, because it has risen sequentially? Are there any concerns, any surprises for you
In
there?
fact, we have already seen the reduction of about 900 crore pullback. There was one, of course, one account in particular was there, which has been slipped, which has got slipped essentially on account of the weakness in the account. So we'll have to look into this account and see to it that we do some restructuring.
But in terms of an outlook for FY24?
I think it is more or less.
So you're at 25
there is
basis points credit cost.
I think we should be in a position to, our effort is to maintain at this level.
Okay, so finally, you know, there's been a lot of concern in the market about what's going on with Paytm, you know, with the regulator cracking down on their payment bank. First, if you could clarify for us if you have any sort of commercial relationship, any tie-ups for lending with Paytm that might get affected?
No, we don't have any such tie-up.
Okay.
And we maintain some account of theirs, and which is more like a settlement account.
Okay.
So we have no such issue as far as the Paytm bank is concerned, or maybe its impact on the bank overall.
But you know, given that SBI has come to the rescue of several you know, financial entities in the past, we wanted to understand, is that something you would evaluate at any point of time? Because you have, of course, your payment bank tie-up with Reliance. But you know, is that something you would consider when it comes to Paytm payment bank?
We will certainly consider how to service such customers who are being serviced currently by Paytm, but nothing beyond that.
So no, an acquisition at least is ruled out. But what would you say is a larger message for the industry? You know, with such instances coming to light, we're seeing this, you know, increasing focus, tie-ups, collaboration with banks as well for the promotion of digital lending. But what will be the larger repercussions of the Paytm episode for the industry, you think?
So the message which is there for each one of us is to ensure that, to recognize that the contagion impact of any such thing happening. So that's why whenever we engage with any of the partners, we have to be sure in terms of the governance, underwriting, and also the risk which are inherent in such relationship. Because I think it is very important that the contagion in the sector should be avoided by all means.
But do you think, you know, whether it is a common man's perception of fintechs, whether it is the investor's view of the sector, is that going to be shaken because of this episode?
No, I think one has to acknowledge the fact that financial sector is a tightly regulated sector, and rightly so, because the kind of risk which are inherent in it, unless and until it is tightly regulated, the whole system can be at risk. So that is the reason why it is tightly regulated, and we should be respectful for the regulatory prescriptions in such cases.
Mr. Khara, it's been a pleasure speaking with you. Thank you very much for your time.
Thank you. Appreciate it.